Hello everyone, this is Luis here. You have in the background here my audio is CNBC talk about the Starbucks is 17% deep, 15 points, big dip from Starbucks. I should have played that, I didn't do it, so I don't know why. Today we have at 2 o'clock, let me lower the volume. At 2 o'clock we have the Fed. It's going to talk about the cuts or increase maybe. They don't know in the market for the. So right now Nvidia is trading low. I believe it's A14. Let me see here. I think it's A14. I think A28 actually hit A14, A12 hit A12, A28 right now. So there's some I think all that have open at the moment. Still those two AMD. I closed the 140 at $90 in the morning. Probably hit a little bit over. Let me see. I would say 130 maybe. Let me see here. Open AMD 40. Yeah, hit somewhere 147 because open I sold for 90, it went down to 36, and then around 8:15, 120, actually 11:20 a.m. went to 127 and dropped 11:45, and then it went up again at noon at 147, and now it's dropping to 82. So I sold the 90. I could make another $40, but let's put let me see here, what can I do with this? Put this one and maybe see if this works. All right, so we have the options on the left, live, and we have SPY on the right. This SPY, SP500, trading right now at 0.21. Yesterday SPY dropped big time, 1.58%. I had like 507 put. I closed early. I should have hold, and anyway, I make $5 in my account, one of my accounts. So Riyadh might bounce. Yeah, it bounced. That's what I think about it. Riyadh bounced from the bottom, $10 right now. So let's see. The ones I can close today. Look at this. It's unbelievable how this dropped dramatically. Because Nvidia is very related with SPY, so I think that if SPY go up, Nvidia go up. If Nvidia go down, SPY go down, because they say it's very related right now. I opened Apple for tonight, trading right now 170, so I got 160, 180 straddle. At this point, down 5%. Apple is good so far as I understand, because the IV is very, I mean, it's still like 60%, but I think like probably, I mean, it has to move. Today is tomorrow. Tomorrow is the earnings. So actually, I opened today. You see tomorrow how it goes. Hopefully we got some improvement. Other than that, it's gonna be I think I made a mistake. Big mistake. Today I can close today tomorrow, if you open inside this range over here, they're gonna be dead. It's not gonna move 5% on the day unless move today 5%, because or down 5%, up and down 5%, because we'll have the decision in 8 minutes from the Fed. At this moment, we are just minutes away. I believe it's 2 o'clock, if I'm not mistaken. Let's take a look here on the calendar. Economics, GDP. 8:30, 10. Brazil. 2 o'clock, yeah. Federal interest rate decision. 5.5, 5.5. United States Attorney, See how it goes. So we're 7 minutes away from the decision from Fed. And so let's wait, see how it goes. On my Webull account, I only can close the AMD. I have a call on SPY and a strangle from the Apple. I cannot close. I have a strangle for AMD, and I kind of knew it. AMD would take a hit, but I should have closed the call because I was making money last night and hold just the put. But I don't know. It's stupid of me. I should have done that. Okay, on my chart right now, it's zoom in. It's very like nothing happened at this point. Okay, 1 minute. Let's go 1 minute. Let's go this. And let's go scalp price chart only. This one. Alright. Gonna hit this bottom here, kind of hold it. See how it goes. Zoom out. Just open like that. It hit it this morning. It's still 499 kind of support. But big resistance over here on 501. Try to become positive at this point. Let's see one thing here. Hmm. 4 minutes Fed decision. 3 minutes.
As we head into it, some big reactions on earnings, among other things. There you see the industrials, the loan index that is markedly higher by 113 points, but the S&P 500 and the Nasdaq Composite are roughly flat, let's call it. Starbucks, meantime, falling to a 2-year low. Supermicro losing more than $100 a share. We've been talking a lot about that one. On the upside, however, is Pinterest up nearly 18% at 39.35. Meantime, let's get right to our all-star panel with the Fed's decision just minutes away. Joining us are David Kelly of JP Morgan Asset Management, Kristen Bitterly of Citi Wealth, and Jim Caron of Morgan Stanley Investment Management. Let's talk a little bit. Welcome first to all of you. David, let me begin with you and just sort of get your thoughts as we head into this meeting. I know that you are sort of in the camp that says there ain't nothing coming, but we got to listen to what gets said.
Well, yeah. I mean, when it comes to interest rate cuts, I think the Fed's basically ready, set, wait. And so we're just going to have to wait a while here because inflation, the last few inflation reports, the CPI, just a little hot, the ECI number a little hot. So I think they're just going to, the message is going to be, look, we're not about it. We don't think we're going to have to raise rates again, but we're going to take our time about cutting rates. And they want to give a sort of generally focused message that they just don't have any tolerance for sticky inflation, and therefore they're no need to cut right now.
Kristen, so what could be the worst thing the Fed could say in its statement or in the press conference that would spook the stock and bond markets? What would be the danger word?
I think the danger, it actually would be two things. One is that inflation is more entrenched, and two, Chair Powell is going to be asked about whether a rate hike is on the table. And so anything that would allude to that, I think you would see a market sell-off. That being said, I don't think he's going to do that. I think exactly as David mentioned,
Go on 30 seconds
we still see the trends overall going
on the
in the right
SPY.
direction. We didn't have the data that we needed within Q1, so we need a more disinflationary trend to begin
1 minute.
the cutting cycle. But I don't think there's going to be too many surprises.
So let's talk a little bit, if we might, about, Jim, the idea of slowing down the runoff of the balance sheet. Do you expect there to be much commentary on that, and how important is that if we do hear?
I think there will be a question on that, and that always comes up. It is important, but I think it's all very forecastable. I don't think there's going to be any surprises on that. I think really the surprise factors are going to come in terms of like what I call a crisis of confidence at the Fed, meaning that there's a crisis of inflation confidence in terms of what this bumpy path means towards lower inflation. How long are they willing to give it, or do they have to reset the inflation clock now and need to see
There we
3
go.
months in a row at least?
Computer's going nuts right now. 30, if you're trading view is a good indicator.
Balance sheet runoff is going to be important, but I don't think that's going to carry the day today. I think that's going to be just well baked into the news.
So, David, let me come back to you.
Okay,
very
good
quickly
news.
with the same question I asked Kristen there, which is, what would be the scary words that could come out of this?
Hike. I mean, if the Federal Reserve were to say that they're thinking about hiking rates, then that would say not only that we could have higher rates, but also the Fed would be admitting that they somehow got it wrong. I don't think they're going to do that. I think they desperately want to stay where they are for a while and then cover it this year. So the worst thing they could say, though, I think for markets would be that they're actually contemplating hiking.
All right, we're going to come back to the panel in just a moment. Meantime, let's go to Steve Leisman for the decision.
The Federal Reserve leaving rates on hold in the range of 5.25% to 5.5%. It does note a lack of further progress on inflation in recent months. The prior statement had noted that there had been progress. It says the risks to achieving the dual mandate have moved towards better balance in the past year. Note that they had
Going up.
moving, so that's another kind of reference to stalled progress on inflation. It repeats that it does not expect a cut until it is confident inflation is moving towards that 2% target. It reduced the quantitative tightening runoff to $25 billion from
502.
aggressive reduction there, and that begins in June. A way to think about this is, if my numbers are right, it's a runoff that had been going at $720 billion a year of treasuries, by the way, down to 300. It left the runoff of mortgage-backed securities the same at $35 billion. Again, that QT goes from 60 to 25 on treasuries and begins in June. That is a cap on the reduction. On the economy, the Federal Reserve says continues to say the economy is increasing at a
Won't
solid
change.
pace. It says job gains have remained strong. Repeats that inflation has eased, but again noted that progress has stalled. And I'm going to repeat some statements.
Bears try to push down.
Around, but maybe now they're perhaps more important. It said the committee strongly is committed to bringing inflation to 2%. They're highly attentive to the inflation risk.
Bears try to push up. Bulls try to push up.
I'll give you a few minutes to dig a little deeper into those words and think about the effect of them. Let me come back get back to our panelists and reaction, we're also going to welcome in Rick Santelli and Bob
AMD.
Pisani. Why don't I just go to you, Rick, and get your quick thoughts?
You know, there's been some volatility in the 2-year, the 5-year, the 10-year, the 30-year, and the dollar index, but net out of the volatility, we saw up yield, down yield, but we're virtually at the same spot as before. Steve,
Come on, man. Move something.
Drift a little lower, and I think that speaks volumes. Interest rates have come down from some of the peak levels earlier today, but they're up on the year, very close to some of the highs. And if you go back to the last meeting in March, we're significantly higher when we were then. I think that the salient feature here is simple. We have a stagflationary environment. Growth isn't bad, okay, but it is definitely moving a bit lower. The glide path seems to be lower, and we know that there's not only sticky inflation, there's pockets of inflation that are going up. Even though we seem to read that so quickly, nobody can hardly hear. But I go back to the same old song and dance, okay? My song and dance is easy. If you look at the last 2 year, 69 billion record size, last 5 years, 7 billion record size. The first primary auction of 10s in February at 42 billion record size. We have what, 818 billion now to service the debt on its way to $1 trillion, and we're at 34 trillion in debt in the U.S. We're 312 trillion debt in the globe. To me, the big feature here is sticky inflation is going to mean rising debt levels, and it's going to leave the government very little wherewithal to jockey around discretionary spending, and this all comes at a time where I know we're cutting back down to 25 billion on runoff, and also, like in Poltergeist, they're back. Buybacks are back. That was part of the Treasury announcement today. So we have QT ramping down, buybacks moving up, even though we're not easing. It's been voiced as a liquidity issue. I'm not sure. Liquidity issue really seems to be synonymous lately with rates going up quickly. But maybe they're going up quickly because spending's going up quickly.
All right, Rick, thanks very much. We'll come back to those thoughts in just a minute. Bob Pisani, let me turn to you with the equity market reaction.
Very small. S&P was down 11. Now it's only down 5. The key sentence here is in recent months there's been a lack of further progress toward the committee's 2% inflation objective.
The market liked the results.
The issue is, are rates
We're high right now.
to keep bringing down inflation?
So what's the next resistance in 5 minutes?
Seems to think that there might be higher rates coming. The stock market, I can tell you, is very afraid of that. Remember what happened last year when the 10-year moved towards 5%?
NVIDIA just already moved from the bottom. SMCI moving from the bottom. I didn't have Apple here. Why I don't have an Apple here? Let's put an Apple.
To the extent that they did not put hikes on the table,
Apple.
indicate that that's a positive read right now. Broader term, the debate down here is the biggest threat to stocks the fact that disinflation is not occurring fast enough, or is there a slowdown in growth? People are a little spooked by these earnings reports from McDonald's, Starbucks about a slowing consumer. My own sense is the low-end consumer is having a hard time.
The dollar
Is
is
not at all. So right now,
took a hit. 106.
that it would be any slowing.
VIX.
So, Kristen, Rick, let's flip the word. I know it was intentional, but very intentional. A word that has been in my head for some weeks now, and that is stagflation. Is that where we are right now?
VIX is not moving.
I think we have to go back to looking at
SPX.
2023 and the data that we had. So when we see the third quarter and the fourth quarter, we had really strong GDP. We also saw disinflationary forces that were really, really strong and better than anticipated. Q1, you saw a little bit of normalization, right? So you saw inflation not coming down, CPI certainly not where we wanted it to be for Q1, but I would call that more normalization.
So they already got
Even though low expectations. When you factor out imports and you factor out inventories, all of a sudden it looks like a pretty solid GDP print. So I think that Q1 was about normalization, and the data in Q2 really matters for the Fed's trajectory from here and the overall economic backdrop.
Jim Karen, the fall off or the runoff from 60 billion a month to 25 billion may have been a little bigger than some people expected. React to that, and what in a practical sense does that mean to the markets and to consumers and the general public?
Look, I mean, I think Rick summed it up. There isn't much of a move in the rates market right now, and I think that's exactly what we should be focusing on. we're anticipating that the Fed's balance sheet is going to adjust. And I also think that a big balance sheet is a form of easy policy, so I think this does need to adjust over time. But Tyler, let me go back to what I said before, which is that this is really about resetting the clock for the Fed. When do they start to get confidence that they can actually start to cut rates? And this is the debate that's in the market at this point. So the debate is whether or not they, if you go by market pricing, is the first cut in December, or many forecasters
Still up $10 on Nvidia.
Going to be the labor report. If the labor market starts to weaken, I think that advances the time scale for the Fed to start to cut
38.
earlier. But if the labor market stays strong, I think that they're going to stay on hold probably until
Coca-Cola 62. Coca-Cola went up. So my calls might coming in play.
Seeing this as stagflation or in any way, shape, or form. Stagflation is high unemployment. It's high inflation. It's no growth. We are so far from any one of those.
Come on, need this move.
But stagflation assumes something that's sort of broken in the price mechanism in the economy. And what would be broken there would be that if you do have weaker growth, prices would not adjust downward. We don't know if that's the case. I just think we're a very long way from stagflation. As for the Fed, I would say this. This statement reads to me like a plane that's circling. They're waiting for time. They acknowledge there are a little bit of turbulence in the air there. They perhaps see some fog on the runway. So they're not quite ready to land yet, but I do think they want to land this plane. I think they're still on course to try and land the plane, Tyler. It says that this is a holding pattern, this statement here, before the data either breaks weaker growth and lower prices, and or you get a move higher in inflation, which would engender a different kind of response.
Calls for tomorrow.
David Kelly, let me get you to react to what Steve just said. Are we far away from stagflation? Are we nearer to it than might be comfortable for the Fed? What do you think, or is that really just not even on the table?
I completely agree with Steve. We're very far away from it. We've got unemployment below 4. We've got consumption to greater inflation below 3. 3 plus 4 is 7, but 3 plus 4 is also good. These are good numbers for the U.S. economy. Growth is slowing, but it's slowing at a modest pace. So really the economy is fine here. There's nothing wrong with the economy. It's just all a little too hot for financial markets who are banking on big rate cuts from the Federal Reserve this year. But even the statement, I think the one thing that strikes me is they could have cut the Treasury runoff from 60 to 30. The fact that they went that extra $5 billion, it probably doesn't sound like a lot, but it does say that they're trying to send a message here that they're not going to be too hawkish here. So if anything, I would regard the statement as being slightly on the dovish side, and it gives me more confidence that they won't hike again, but they will eventually cut rates this year.
I'm going to come back to all of you, or several of you, on a terminal question here about the terminal rate of interest rates. But Rick, let me just turn back to you for any reactions you have.
You know, to me, it's not that my sources or many people I have confidence in to gauge the future of the economy are saying stagflation's here. What they're saying is it's a rate of change argument. It's impossible to look at the GDP report and not say that growth is slowing, the rate of change is slower. So yes, the economy's fine, but it's much less fine than they thought it would be. It's much less fine than the previous quarter. And if you looked at the pricing components in the last GDP report, inflation, the rate of change, is moving back up. So it isn't that stagflation's here. It's that you can't put your head in the sand, okay? We had guidance from a dovish Fed that was very wrong, okay? Didn't hear much grumbling about that. But to have forward-looking notions regarding the glide path and rate of change of the economy that may point to stagflation, that to me makes sense, and I don't think we should ignore our eyes. Our eyes aren't lying. Things are slowing but still growing, and inflation stopped going down. You could call it anything you want, but what you can call it is a reason to ease.
How about what Rick just said? Who would like to react to that?
Well, I'll say something. Just briefly, just from the stock market's point of view, I cover the stock market here. The reason the S&P was down 4% in September was not because people were concerned that earnings or the economy were falling apart. The concern was higher for longer interest rates would bring down the multiple. So instead of 21 times forward earnings, we went down to 19 and change, because higher for longer, of course, impacts future stream of earnings, so the perception of the future stream of earnings. Now, if there is some kind of slowdown in the economy, which we don't see yet, or the job market slows down, then the earnings numbers themselves are going to start coming down, and that's a whole other scenario.
Yeah, but Rick says we are seeing a
slow.
slowdown in the economy. Rick said you've got to look at the numbers.
Yeah,
they
but
are
Tyler,
slow.
Tyler,
here's the
the
thing.
jobs
If
numbers
we're-
is what matter. They're still pretty robust.
I'm going to let Steve jump in and then Jim. Steve, go ahead.
I'll keep it quick. The idea of that means stagnant. It means we're not growing. A slowing in the pace of growth is what we all have wanted. It is the soft landing scenario. So it would seem a little bit extreme to me to jump from we got the slowdown we wanted to the idea that the plane is stalling and about to crash land. Look, I think Rick is right. You got to factor that into your possibilities. I just don't think it's the most probable outcome because of what you expect to happen with prices in that scenario. In the scenario of stag, you get D, not inflation.
Well said. Jim, I want to get your final thought, and then I'll go one more time to you, Kristen, and David. Jim?
So look, I think it's premature to talk about stagflation, but there's a lot of noise out there, so let's focus on the signal. Tyler, you were going to talk about the long-term terminal rate. I call that the forecastable horizon of Fed policy rates. What the market has been very stable on is that the market still believes that the Fed policy rate's going to 3.5 to 3.75% sometime by 2026. How we get there, how quickly we get there in 2024 and in 2025, there's going to be a lot of debate about that. There's going to be a lot of noise. But what keeps the market stable?
It pops up. I got 1 minute, 2 blocks over here. 3 minutes, the blocks. Buy earlier, 499. The resistance at 3 minutes, they're stronger.
So that's where I wanted to end things. And that,
So the only blocks on the buy are very stable.
Jim just said 3.5,
Trading
3.75
between
by 2026.
the resistance and support being 502 and 500.
Maybe it's just not too hot, not too cold.
Exactly. I think it's higher than what we've experienced, certainly, and it's higher than what expectations are. I think since we've seen resilient growth, and I'm going to go back to something that Steve said, where it was, we are seeing a decline in the growth rate. We're not seeing a contraction. We're seeing a slowdown in growth, which is exactly what the Fed wants to see. Whether that's the data that we've seen in GDP, whether that's the data that we saw in JOLTS this morning. And so finding exactly what is that neutral rate and what is that balance is something that I think that the Fed is going to take its time, and it's going to do it gradually in terms of the rate cuts that we'll see in 25 basis point increments, that if we get the data from an employment standpoint, we get the data from a disinflationary standpoint, we'll still see maybe even up to 3 cuts this year.
Mr. Kelly, you get the final word.
Okay, I do think the terminal rate ought to be higher because I think that 2.6% is too low for financial markets. But on the state of the economy, I know the numbers are getting a little worse on inflation temporarily, but that's kind of like saying, a teenager gets older every day, it doesn't make them old. And so this economy is really much more like a teenager than an 80-year-old right now. It's an economy which is showing plenty of potential for growth. Inflation, I think, is still sticky, but probably trending down. Unemployment is very low. This is actually a pretty good economy for Main Street. Not quite as good for Wall Street if you really want short-term rates to come down to 2.5%. But frankly, I think this is a glass, not just half full. This is a glass about 80% full here.
All right, that wraps our conversation. Thanks to our panel. Lively conversation. We stirred the pot a little bit there. Thanks so much to all of you for your participation today. Really appreciate it. All right, coming up, we will get more reaction to the Fed leaving rates unchanged. We're going to get reaction to the Fed doing nothing. No, that's just a flippant way of saying it. We're minutes away from Jerome Powell's press conference. There, you will get a real chance to hear the thinking behind the Fed's actions today, or non-actions. We'll take you live, but first a quick break.
Okay, we're in the break from the CNBC. You guys heard it, what they have to say. Look on the SPY right now. It's very pressures from all over the side. The bears and the bulls, they're getting a big fight going on right now. I was wondering if it probably happened yesterday, moving 1%, but with this decision, it's just it was pre-sale from yesterday, so I don't think we're gonna see much going on today at this point. I could be wrong, but Right now I'm down 11% on my Weibo account. That's the only one I can trade it today, because the other two I have 0-day trades to do it, and all my positions it's for today that I opened. And let's see, yeah, I mean, Nvidia started taking a dip now, kind of like probably pushing the market. Apple also probably like not doing well. 12%. Come on, man. Do something. And just create more resistance. Okay, my loss gonna be on 15%. When I hit 15%, I close. If I go loss 15%. So the QQQ open a call for tomorrow, but I don't think with Nvidia going down, probably gonna pull everybody like AMD and everything. Close AMD, I should, but you know, options at time decay, so I can take too long. 3 o'clock, 3:30, they close my position. My call on a SPY 506 for today, and my put for tomorrow is 493, which is way off. It's 8 points off the target right now. I don't think we're gonna move another 1.6% between today and tomorrow. It didn't move as much today. It just like back to even with 0.10% on the SPY. There we go. Okay, coming back. So the Dow Jones is up 147%, 0.39, 146 points, 0.39%, 37,900.
All right, welcome back. Let's get a little more reaction to the Fed. Rick Santelli is back. I feel a little guilty, Rick, for maybe putting words in your mouth on stagflation. But the essential thought was really whether we're at stagflation now or not. Your thought was, and I want you to elaborate, was the idea that you've got growth slowing at the same time that the decline in inflation is abating and maybe moving back up. And so it may be a low probability that we get to stagflation, but you can't dismiss it out of hand.
No, listen, Tyler, there was a lot of ifs and maybes that our guests put forth, okay? Maybe this will happen. I'm a numbers guy, okay? I look at the numbers, the hard data. GDP in the first quarter was 1.6. In the fourth quarter last year, it was 3.4. That is much slower. And if our guests say, well, wow, 3.4 was too strong, I understand that. But what was the consensus call? 2.5%. We got 1.6. I'm a numbers guy. That's slowing. And if we look at the GDP price index, it was 3.1. Okay? Last look, it was 1.6. And the core was 3.7 versus 2%. There is no denying the hard numbers. Now, we could question whether the numbers the government puts forth are accurate, and many who look at the labor markets don't think it is. But I will go with the numbers. I don't like changing midstream. So it could be a consensus call that stagflation is a low probability, but it's a significantly higher probability than it was a month ago, and much more significantly higher than it was a year ago. And once again, the guidance from the Fed has been very wrong. People want to blame the markets. You could say dot plots, you can point to anything you want, but even the Fed chief Powell has had a lean towards move. They still have a lean. The question isn't whether they're going to ease, it's that they're going to ease. But what if inflation goes to 4.5%? So I'm a hard numbers guy, and the numbers do not back up most of the conversations I hear.
Well, he will certainly be asked, won't he, in a few minutes' time, in about 8.5 minutes' time, he will certainly be asked whether there is a possibility that inflation resurges and he has to raise rates.
Yeah, that's not my base case, and to be frank, my base case isn't necessarily stagflation. But I think that if you have a runway long enough right now to consider all the moving parts, I cannot dismiss how debt is a growth killer. And it's not only domestic, it's global. And it's only going to get worse. Even the IMF's numbers.
Bye-bye.
Global growth kicking up a little bit, potentially in the next 12 months. But if you look at their longer term prognosis, that is going to dwarf growth, and it's going to be like an anvil on top of the shoulders of growth.
Well,
I'm holding
worry
this too.
about the volume of debt that we've added to the economy, and now at higher interest rates, how much more we're having to pay to surface that debt. Let me come back though to the stagflation discussion that we had in the prior block. If I discerned from sort of that panel's discussion that it was that, well, yes, the economy is slowing, inflation may be sort of plateauing, but this is the soft land. This may be the soft landing that everybody was hoping for. How do you react to that?
I just think it's too early to tell. I can't tell if we're going to have a soft landing. If we get a CPI that moves up significantly, soft landing could go out the window. And it isn't only about the soft landing, just your discussion about what the terminal rate needs to be. There's no way to really tell what the terminal rate needs to be. There's no way to tell what it will be. So some of these variables that are so intricate in plugging into the Fed's models are just assumptions, and we really don't know. And anybody who's looked at how many variables, the Wall Street Journal did a report on this. I forget how many variables are in the econometric model that the Fed uses, but there's a boatload. And I'm not saying that it isn't the best model on the planet. I'm just saying that we don't know how much air we're going to have, and a little bit of air in the marketplace has a huge distortion when you move 2, 3, 4, 5 quarters down the road.
Tell me I'm crazy, Rick, which many people are more than willing to do, but about this sort of assertion. Neither the Fed nor the Fed futures market have been particularly good about predicting what's going to happen. The Fed was talking about transient inflation for a long time before they took the word transient out of the conversation. Now the Fed basically is saying, well, we're going to be ready to cut rates, but now maybe not so soon, not so fast. The market, similarly, last fall, thought there would be a lot more rate cuts coming this year than the market says today. So who's the good predictor here of either what the Fed is going to do, what inflation is going to do, what the economy is going to do?
Tyler, if I tell you that the Chicago Cubs are going to have 3 pitchers that are going to win 30 games this year, you'd probably raise the chances of them going farther down the season and doing better potentially in making playoffs. Well, what if the pitchers don't win 30 games? See, here's the issue with those predictions, is that the market is listening to the Fed. The whole premise of Fed guidance is to guide the market by the nose, okay? And when you still have a huge balance sheet, when you're still tinkering with rates, how can the market actually rise to the occasion and accurately price risk? In my opinion, 4 weeks ago, you did not see an ease in today's Fed meeting. That's what the Fed contract is good for. And anybody who thinks that looking today is going to give you an accurate picture of July, September, D's, and Fed fund futures, I think they're misguided. It really is for the next meeting, and only when you get within 4 to 6 weeks. And if you look at that as the criteria, the contract's almost infallible. What we are looking for that contract to tell us is impossible, okay? And just because traders are putting their money there, it isn't that it's wrong. It's so the Fed is positioned them that way. And in addition, the Fed fund futures contract and options, in large part, may be a hedge. And the hedge doesn't necessarily give you the entire picture.
So what I'm hearing you say there is that the market, in its predictive value, is kind of like a long-range weather forecast. It's going to be a hell of a lot more accurate predicting what's going to happen tomorrow or a week from today rather than what's going to happen a month or 8 months from today, correct?
Bingo, you nailed it. That's
Right.
it.
On that, if I get an A from Professor Santelli on any day, I appreciate it. All right, Rick, thanks, my friend. All right, let's get some final thoughts as we count down to Fed Chair Powell's press conference. Mike Santoli joins us as well as David Kelly. David, why don't you kick it off? I don't know whether you heard the last part of that conversation. I asked Rick fundamentally, who's the better predictor here of what rates are going to do, what the Fed is likely to do, the Fed or what inflation is going to do, the Fed or the markets, or are they both equally wrong, equal amounts of time?
Well, I think you're both spot on that it's like predicting the weather, 10 weeks out. But investors should invest based on the climate, not the weather. And we've generally got a good economic climate here. And we've got a climate that seems to allow steady economic growth. I do think that inflation will gradually moderate as it did for many decades before the pandemic. And the unemployment rate seems to be pretty low, and the workers don't seem to be demanding huge wage increases. So the climate's pretty good. The weather's going to bounce around. But long-term investors, shouldn't play the trading game here. They should invest based on that climate, which, as I said, I think is pretty positive.
Good wisdom there, Mike Santoli. Your reactions to the Fed decision and what we might expect to hear from Chair Powell.
Yeah, clearly the market is taking it as the Fed electing not to turn more explicitly hawkish. There was perhaps some idea that it might do that. It just acknowledged the data that's happened in the 6 weeks since the last meeting. And of course, in those 6 weeks since the last Fed meeting, 2-year yields, 10-year yields are both up 40 basis points or so. So there's been some market, tightening of financial conditions. The market, the Fed wants to preserve optionality, keep its options open as it usually does, and that does mean being data dependent. So I think that that's sort of better than we could have feared, perhaps, and from the market perspective. The issue to me is the bond market has implicitly been testing the economy's tolerance for higher yields, as the Fed has been testing the economy's tolerance for higher short-term rates. So far, it's been okay, but we're searching for this new equilibrium out there, and I do think that in the press conference, what the market would like to hear is that Powell still thinks you can have inflation continue its decline without undercutting economic growth. That was the main premise of the December pivot. And if he sort of goes back on that and starts saying, well, maybe the services sector really does have to be restrained more to get wage growth down, and I don't think the market wants to hear that there's going to be that economic cost for a resumption of disinflation. I also think they want to hear him point out that PCE inflation is not terribly far from where the Fed thought it was going to be by the end of this year at the latest reading. Remember, there's no dot plot in this meeting, so there's none of that he has to kind of dance around in his response.
Quick final thought, Mike. The Dow, maybe peculiar to the Dow, seems to be reacting in a rather sprightly way. It's up 200 and some points right now.
Yes.
Go ahead.
I was just going to say, all the indexes did actually get a lift on the statement. Of course, Fed day reactions sometimes can really be very much a Quicksilver type of thing. You don't know if the first move is the right move. But I do think that's because there was an absence of incremental hawkishness, plus you had that further decline in quantitative tightening, perhaps beyond what people were projecting.
Yeah, and of course, David, I asked him what the trigger word would be here, and he said hike, anything having to do with hike. And so, David, you were right there. That word has not come into play yet. It will be interesting to see, however, how the chair handles questions about whether an interest rate hike was even discussed in their meetings.
Yeah, he's gonna have to play that one very carefully. I think he'll have to admit it's always possible to raise interest rates, but their base case is still just about the timing of rate cuts, not the option of hiking rates.
And your base case, sir, just once more for the record.
At the moment, 1 or 2 rate cuts, nothing before September, maybe nothing before December, but some cut this year.
Let's go to the Chairman of the Federal Reserve, Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and the continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations